Okay, now let me say something that might sting a little. You are not losing because you're bad at trading. You're losing because you're staring at the wrong thing. You've been handed a magnifying glass and told to study the ocean with it, and then you wonder why you keep getting surprised by the tide. Write in the comments where you're watching from and what time it is, so I can get to know you better. And to support the channel for free, just subscribe and hit like. It takes 2 seconds, and it actually means a lot. Here's what nobody in the trading world wants to admit out loud. The 1-minute chart, the 5-minute chart, even the 15-minute chart, they are not the market. They are the market's emotional reaction. They are the noise, the fear, the greed, the panic, all compressed into tiny candles that feel like signals, but are mostly just chaos dressed up in patterns. And here's what's wild. The more you stare at them, the more confident you get. That confidence is the trap. Because while you're zoomed in on that little candle, convinced you found the perfect setup, the weekly chart is quietly telling a completely different story. One that's been true for months. One that the big money already knows. One that's about to crush your trade. That's what this video is about. Not tactics, not indicators. The thing underneath all of it. The one principle that separates traders who build wealth from traders who just stay busy going broke. Real quick, if you're finding this interesting already, just tap subscribe. I put a lot into these videos, and it genuinely helps. Okay, let's keep going. Here's the thing most people get completely backwards about trading. They think more activity equals more opportunity. They think watching more charts, taking more trades, staying more alert means they're doing more work. And more work means better results, right? That's not how markets work. That's how jobs work. And the market does not care about your effort. I want you to think about the kind of trader you probably were, or maybe still are, when you first started. You opened a chart. Maybe it was Bitcoin, maybe Forex, maybe a stock you'd been watching, and you zoomed in, because that's what felt natural. You wanted to see the detail. You wanted to understand what was happening right now. And what you saw felt alive. The candles were moving constantly, up, down, up again, little patterns forming and breaking. You started recognizing setups, a double bottom here, a breakout there, an RSI crossover that looked exactly like the ones in the YouTube tutorials. You felt like you were reading the market. But you weren't reading the market. You were reading the crowd, the panicking, impulsive, emotionally exhausted retail crowd.
Because that's what short time frames capture. Every 5 minutes, someone somewhere is scared. Someone is greedy. Someone is revenge trading after a bad loss. Someone is betting their rent money on a wick. All of that emotion, all of that noise gets compressed into those little candles. And it looks like data. It looks like signal. But mostly, it's just human fear and greed playing out in real time. Now zoom out. Go to the weekly chart. Look at the same asset over 6 months. Something completely different happens. All that noise cancels out. What you're left with isn't emotion. It's direction. It's the actual flow of capital from people who move markets, not people who react to them. And here's the uncomfortable truth. You and I are not those people. Not yet. The institutions, the hedge funds, the big banks, the people managing hundreds of millions, they're not watching the 5-minute chart. They're reading the monthly. They're planning moves that take weeks or months to fully play out. And when they decide which direction the river is flowing, the ripples on the surface don't matter, not even a little. So when you trade against the higher time frame, you're not making a bold contrarian bet. You're swimming against the current while the people who control the current don't even know you exist. Let me show you exactly what's happening, not just in the chart, but in your brain when you trade short time frames, because understanding this changed everything for me. There's a concept in psychology called variable reward. It's the same mechanism behind slot machines. You don't know when the reward is coming, but you know it could come at any moment, and that uncertainty creates a loop. You keep pulling the lever, you keep watching the candle, you keep waiting for the setup. Short time frame charts are basically slot machines with better graphics. Every few minutes, a new candle forms. Every new candle is a potential setup. Every potential setup is a potential win. And occasionally, just often enough to keep you hooked, you get one. You catch a move. You make $30, $50, $100, and that dopamine hit tells your brain, this is working. Stay here. Keep doing this. But zoom out over the course of a month, and the math tells a very different story. Because for every trade that worked, there were 2 or 3 that didn't. And the ones that didn't, the ones where you held too long, or got stopped out at the worst moment, or watched a perfect setup immediately reverse, Those were the higher time frame reasserting itself. Those were the tide coming in while you were trying to count ripples. Here's a really simple way to think about what higher time frames actually do. Imagine you're standing right next to a river, at the edge. Looking straight down into the water, you can see currents going in all kinds of directions. Little eddies spinning backwards, foam splashing sideways, water hitting a rock and going left when the rest is going right. If you only watched that one spot, you might genuinely not know which way the river flows. But step back, get some height, look at the river from above, and suddenly the direction is completely obvious. It was always obvious. You just couldn't see it from where you were standing. That's the difference between a 5-minute chart and a weekly chart. Same asset, same market, completely different picture. And here's what changes when you start with the higher time frame. You get what I'd call the luxury of being wrong short term. Think about that for a second. If you're aligned with a clear weekly or monthly trend, you can sit through the chaos on the daily chart. You can take a small drawdown, hold your position, and trust the direction because you've seen the river from above. You know where it's going. But when you're trading against the higher time frame, or without even looking at it, you have zero margin for error. You need to be right immediately. Every move against you is threatening. Every bad candle is a crisis, and you end up either cutting winners too early or holding losers too long, both driven by anxiety that comes from not knowing which way the river actually flows. I had a friend, smart guy, analytical, worked in finance, who spent 2 years trying to figure out why his trading kept failing. He had back-tested strategies, he had risk management rules, he had everything you're supposed to have, but every single week he was losing a little. Not catastrophically, just slowly, steadily bleeding. One day I sat with him and looked at his charts. He was trading entirely on the 15-minute. He had a bullish setup, beautiful, honestly, textbook stuff. And I just said, look at the daily, look at where we are on the weekly. The daily was in a clear downtrend. The weekly had just rejected off a massive resistance level that had held for 8 months. His perfect setup on the 15-minute was a counter-trend rally inside a larger sell-off. He was finding signal in the noise. He started incorporating higher time frame analysis that same week. Not perfectly, it takes time to rewire how you see charts, but the bleeding stopped. Slowly, his trade started going further before turning against him because he was finally swimming with the current instead of against it.
Now, I want to address something that comes up every single time I talk about this, and it's the fear of missing out. Because higher time frame trading means fewer trades, a lot fewer. You might look at a weekly chart and realize there's no valid setup, nothing aligns. And your job, your actual job as a trader in that moment, is to do nothing. That is genuinely one of the hardest things in trading, doing nothing. Because the market is open, things are moving, your friends are trading, Twitter is full of people calling plays. Every fiber of your instinct is saying, find something, do something, you're missing out. But that feeling, that urgency, is not wisdom, it's impatience. And impatience in markets is expensive. The patient trader who waits for a genuine higher time frame signal, takes one clean trade per month and holds it, that trader will over time almost always outperform the trader who's in and out 15 times a week. Not because they're smarter, because they're not fighting the current. If this is clicking for you, if you're starting to see your own trading in what I'm describing, subscribe to the channel. I put out content like this regularly, and it's free. Just hit that button. Here's where the mindset actually shifts. And I want to be careful here, because this isn't about becoming a long-term investor or quitting active trading. It's about fundamentally changing how you see the market. Most traders approach the chart as a puzzle to solve. They're looking for patterns, for signals, for that combination of indicators that unlocks profitability. And so they add more data, more time frames, more indicators, more complexity, thinking that the answer is somewhere in the noise if they just look hard enough. The shift is this: the market is not a puzzle. It's a river, and your job is not to solve it. It's to read the direction and go with it. When you anchor yourself to the higher time frame first, something almost philosophical happens to your trading. You stop being reactive and start being strategic. You're no longer hunting trades. You're waiting for the market to come to you. Think about what that does to your stress levels. If you've identified a clear weekly uptrend and you're waiting for a pullback to a key level before entering, you're not anxious about every red candle. You're actually welcoming it. The pullback is part of the plan. The volatility is the opportunity, not the threat. Compare that to trading the 5-minute chart in the same market. Every candle is a decision. Every wick is a potential stop out. You're never calm, because calm would mean you're not paying attention.
Higher time frame trading doesn't just make you more profitable. It makes trading sustainable. It gives you a life outside the screen. Because you're not trying to react to everything, you're positioned to benefit from the one thing that matters: direction. And here's the deeper truth. The reason higher timeframes work isn't magic, it's math and mechanics. When large institutions enter a position, they can't do it in one trade. They're too big. They accumulate over days, weeks, sometimes months. That accumulation shows up on the higher timeframes as structure, as support, as the foundation of a trend. By the time it's visible on a 5-minute chart, they're already in. You're following them, not beating them. So the mindset shift is simply this. Stop trying to be first and start trying to be right. First is for gamblers. Right is for professionals. Okay, so let's bring this somewhere concrete, because a concept without application is just inspiration, and inspiration without action doesn't pay the bills. First, before you look at any trade, before you open any position, before you even think about an entry, open the weekly chart of whatever you're trading. Just look at it. Ask yourself one question. What is the dominant direction right now? Not what you want it to be, not what it was doing last week. What is it actually doing right now on the weekly chart? That's your river. That's the direction you should be swimming. If the answer is up, you're looking for longs. If the answer is down, you're looking for shorts. If the answer is sideways, congested, no clear structure, then you're probably not trading that asset right now. And that's a completely valid answer. Second, drop down to the daily to understand the rhythm. Is the weekly trend moving in clear waves with obvious pullbacks? Are you in an impulse phase or a consolidation? This tells you how aggressively to position and how much noise to expect. Third, and only third, you can look at a lower time frame for your actual entry, maybe the 4-hour, maybe the daily itself. Not to find a new direction, not to second-guess the weekly, only to time your entry better within the context you've already established. That's the whole framework, top-down, higher to lower, direction first, timing second. Now, some practical things to keep in mind as you start applying this. Your win rate might not change dramatically at first. That's okay. What changes is your risk to reward. When you're trading with the higher time frame, your winners run longer. The trend carries them. When you're wrong, you know sooner, because the higher time frame structure breaks more clearly and you exit cleaner. Fewer big losses, more trades that just work themselves out. You will have to sit on your hands more. A lot more. There will be weeks where the weekly chart doesn't give you anything clean to work with. Nothing aligns. And the temptation will be intense to force a trade anyway. Don't. Preservation of capital is not passive. It's an active strategy. And finally, give yourself time to adjust to this. Your brain has been conditioned to the dopamine of short time frame trading. Switching to higher time frames will feel boring at first, even wrong. You'll feel like you're missing moves. You probably will miss some, but you'll stop bleeding on the moves you were taking before, and eventually the math starts working in your favor. This isn't about trading less, it's about trading better. There's a real difference. I want to end with something that took me a long time to actually believe, not just understand intellectually. The market is not against you. It doesn't know you exist. It doesn't care about your stop loss or your entry price or how many hours you spent analyzing that setup. It's just moving, following forces that were in motion long before you open that chart and will continue long after you close it. When you zoom into the 5-minute chart, you're trying to find certainty in a place that doesn't have any. You're looking for patterns in noise and calling it analysis. And every time it doesn't work, you blame yourself, your discipline, your strategy, your luck. But maybe it was never about any of that. Maybe you just needed to zoom out. The higher time frame doesn't give you certainty either. Nothing does in trading. But it gives you context. It gives you the ability to ask the right question. Not, should I take this trade right now, but is the overall environment in my favor? And that shift in question changes everything about how you trade. You'll still have losing trades. Every honest trader does. The goal isn't to eliminate losses. It's to stop fighting the river. It's to put yourself in positions where the market's natural momentum is working with you instead of against you. You're not bad at this. You're just looking too close. And now you know to step back. Take that with you. If this video gave you even one thing to think differently about, subscribe to the channel, leave a like, and drop a comment. Tell me where you're watching from, what time frame you've been trading on, and whether any of this hit home for you. I read the comments and I genuinely want to hear from you. See you next one.